Good afternoon. Thanks for coming, everyone. Welcome to Fundamentals for Startups, a CoMotion Labs production. My name is Claire Inslee, and I am the Associate Director of Events here at CoMotion. We are a multi-industry incubator hosting early-stage startups from both inside and outside of UW. We provide our members with critical infrastructure and opportunities for learning, mentoring, and networking. And we're always looking to connect with founders in life sciences, hardwares, and Tech Plus. Fundamentals for Startups is a weekly lecture series on topics related to entrepreneurship. Every week, we bring in new experts to share insight and answer questions. All of these talks are streamed and saved on our YouTube channel, and you can learn about upcoming events on our website. We have a great library of content, so I encourage you all to check it out. Today, I'm excited to introduce Minda Brusse and a team of her highly capable and smart MBA students. Minda is a founding partner at First Row, and her MBA students are here at the UW in the Foster School of Business. And they're joining us today to talk about the issues that startups run into when they're pitching to investors. Welcome, Minda and team.
Thank you so much for having us, Claire. And thanks to everyone for being here in the room. And really excited to have you. So I'll explain a little bit more context of who we are, why we're here. And then I want to kind of know a little bit about this room of people as well. And then I'll go over some of the areas we'll cover, and we'll be sure to leave some time for questions, because hopefully you guys will have more questions after we kind of tell you a few stories and stuff like that. We're not going to use any slides today, because I feel like that generally puts people to sleep. So it's Friday. We'd rather have more of a dynamic conversation, and looking forward to having you guys ask us lots of questions too. So a little bit of context. I'm the founder, I'm one of the two founding partners of First Row Partners. We're a pre-seed firm. We only invest in pre-seed companies. We don't do any follow-on, and we consider ourselves really a specialist firm in this stage. We invest all across the US. We even have an investment now in Australia, but primarily it's US and Canada. So we've seen a lot of companies around the Seattle area, the Northwest, but we've also really been embedded in the New York and San Francisco, kind of scene. So I have sort of that breadth. The other thing that I get to do is I get to teach a little bit at UW. So I have the honor of teaching the angel investing course, which is for advanced degree students. I love when we get law school students to participate. That is super fun. And so it's all advanced degree students. We have about 14 that are interview and join the class. And they have a budget of $50,000 through the Burke Center for Entrepreneurship to make actual investments. And so by putting them out in different angel groups and VC firms, they're able to see the landscape for themselves and find deals. And part of why we're here today is because we think some of you might be great candidates for one of our 25K checks that we write. So keep in mind that you've got kind of a hot lead on potential next investor. And the other thing I do is I teach the CDL course, which is also for advanced degree students and exceptional undergrads, that follows the CDL program throughout the entire first 2 quarters. And then you get to do a little volunteering to kind of see the rest that happens. So through that, I've gotten to see a lot more of the life sciences and deep technical founders that are coming through and commercializing research. And that's just been a real exciting thing to get to view about the UW. So really proud of what the UW is able to do and capable of. So that's a little bit about us and the context and why we're here. We'd love for more people to know about our angel investing class and be knocking on our doors to pitch us or ask us to be, maybe you just want us to review your pitch. We'd love to be more connected with the entrepreneurs on campus. So that's a little context, and then I'll let each of them introduce themselves here, and then I kind of want to get to know who you all are as well. So Tammy, we'll let you start.
Hi, everyone. Can you hear me okay? Yep. Okay. Hi, my name is Tammy Yu. I'm a second-year MBA student, and really enjoying the class and looking forward to meet all of you.
And which firm are you placed with?
I'm placed with Keiretsu.
Mm-hmm. So Keiretsu Forum is I would say like a deal flow machine. they see so much activity. And so that is what you get to see as part of this class.
Yeah, every week they have a deal screening meeting for like 3 hours, and that's already for the deals that has been on a certain pretty good stage that present to the community, and then they will decide if this deal will move forward to the next stage. Mm-hmm. So it's a lot of deal flow going on, and really interesting to see.
Right. And Yulei.
Hi, I'm Yulei Wang. I'm also a second-year MBA student with Minda here. So my past experience involves later stage M&A, investment banking. So I'm kind of familiar with the exit strategy. And also I found my own makeup brand 3 years ago, and we achieved over 1 million revenue with double-digit profit within 1.5 years. But after I think it was a year that ChatGPT came out, I feel like, okay, CPG might not be my end result I want to pursue. So I chose to come here and pursue an MBA degree and learn more from big techs. And currently placed with Madrona. So this morning I just had a meeting with Tim Porter, one of their partners at Madrona, and I think Tim, he has a long-standing relationship with CoMotion, and he's also looking forward to join CoMotion Lab and have some later talks with founders here too. Yeah.
Great. Aaron.
Hi, everyone. Oh, wow, that's very loud. My name is Aaron, and I am also in the angel investing class. This past year, I spent 8 months at Pioneer Square Labs in a fellowship, and then weird kind of MBA internship where I got to build a portfolio company for them this summer. This year, I'm working at PAC VC, which probably some of you know is a VC firm that only invests in UW spinouts. So people who build things here or who have graduated from the university or who are professors. So it's been really fun to kind of see both the studio side of deal flow and also the PAC very UW-centric part of deal flow. And currently my big project is I've founded a climate tech conference that's happening in a month and bringing entrepreneurs together to kind of ideate on new ways to
Do you have any space left in your conference? You're like oversubscribed.
Yeah, it was oversubscribed according to the chef, but not according to the housing spreadsheet. And so it's if that's something that you're really passionate about, come talk to me after this, and I can see if I can negotiate an extra spot with the chef for you. Yeah.
All right.
Yeah.
So it's going to be good food up in the San Juan Islands at the UW Oceanography Center.
Yeah, I'm pretty excited for it.
Yeah. So you've got a lot of very entrepreneurial kinds of people up here, and I started doing entrepreneurial stuff back when I was like 6. And I think that's probably common for a lot of people who are in this space. I mean, my favorite toy was a money box and a typewriter. So I'm pretty much living my dream. I think that, that is probably a through line for a lot of us that are just really interested in starting things and doing things and excited to meet other people like us. So let's hear from you. I'd love to know who in this room is in the process of working on a startup. All right. Who is thinking that might be next for them? Awesome. And who's done more than one startup in their career? Okay, great. Who in this room has raised money from private investors, either angels or venture capitalists? Okay, just a couple. Great. All right, well, I think you're in the right place and looking forward to it. So a couple of the topics that we brainstormed together and we think you'd be interested in before you ask us questions and tell us differently is a little bit about sort of what is the outcome of a good pitch? Because there's a lot of pitch 101. I mean, you can watch my recording that my business partner and I did, and you can hear all about that from a lot of different places. That's pretty common knowledge, but I think we have some takes on it that might be interesting to you that are not just about which slides you need, but really about like, what are you trying to do with a pitch deck? We're also going to talk a little bit about team dynamics and founding teams, because it's one of the top 3 reasons companies fall apart. Another is just sort of, when is venture funding, and assuming that angels sort of fall into that same category, They're sometimes a little different, but when is that kind of funding a match for what you're building? Because I think a lot of times we just sort of assume that it is. But from a VC perspective, I think we can tell you a little bit about what those parameters are and why they exist. And then also just, what are you supposed to know about investing to begin with as an entrepreneur? What are you expected to know? And when is it something that you just learn as it comes up, right? So how do you prepare? And, you know, heads up, you don't need to be an expert, but you do need to surround yourself with the kinds of people that can help guide you through the process. So anyway, that's kind of the gist of it. So let's start out with some fun stories. You know, I mean, that's always good. Let's talk about co-founders. I've had 2 co-founder divorces. Yeah, who here has had a co-founder divorce? Yeah. So I'll talk about one of mine, and you can talk about one of yours. But it was in a company that I co-founded with someone that I met through the ecosystem, and we were a really good match for each other. And we set out to build a standalone food and beverage market that could go in office kitchens, but that had a payment system connected to it where people could check out and could also store funds and things like that. It was, you know, the payment system was actually pretty complicated. And we were going to license the thing out to vending machine companies. So that sounded right up my alley to be a co-founder, to him being the technical one. And what we found is that the test markets that we ran were where all the profit was. And that we really needed to change our business model. And instead of being a company that built sort of infrastructure that we could license, we needed to actually become a snack market company and do it. And what that meant was that I was going to be spending the next 5 years doing something I'm not very good at, which is being super operational about moving inventory and food around. And I was not going to be the best at that. I did know how to weasel my way into an office and get to talk to the right person, and I loved cracking the code on that, but I also wasn't going to be the one selling these markets. So it was, I think, a really good conversation that he and I had to just say, like, we need to change the company. We also, you know, need to transition me out. And that was okay. It really was. We've stayed friends. I stayed on as an advisor. And so what he did was he held on to my equity, but as he was going forward to raise capital, he was going to need to change the percent of ownership that I had. And I knew that because you can't have dead weight on your cap table. And as much as I would have liked to continue to own a nice big portion of a company that I wasn't involved with, that was going to make it a non-starter. So, question.
What are the parameters for, basically diluting that dead weight?
Yeah, you can change your cap table with a lawyer and some signatures. You can change those things. The thing is people disagree on what that should be. And so my just little piece of advice is that both people need to be grounded in the idea that it's not about them personally, but it's about protecting the company and making it viable going forward. And so as you depart a company, you do not want to kill the company. You may be really angry with your co-founder, but you don't want to tank it for its future. And so it's like having children in a divorce. So, yeah. Yulei, what's yours?
I totally agree with that. It's like having a children when divorced. I would say like my biggest takeaway from my co-founder divorce is that never really have 50-50. Which I should have known because I was in finance major and my co-founder, she was also doing VC, but we still went that way. I think, so my story is about my makeup company. So my co-founder and I, at first, we are classmates and we are also friends. We were also friends maybe. And so, we felt that we were a good match because she was early stage investment and I was I have more expertise in later stage exit strategies. I would say that the capability match might be one element you're looking for, but also the other core matches you want to look for from a co-founder is also mindset and sometimes even personalities. So I think I wouldn't say a failure, but I would say a caveat I would look for in my future startup would be that really have a boundary between the friendship and your business partners. And maybe that's why I would be more hesitant to bring a friendship over to a business partner, because there'll be lots of like misconception about what you were belong, like having a good time and very good to hang out with, but actually you will not be able to work collaboratively. At first, after friendship, it's kind of hard to really discover a person's difference in mindsets in doing business compared to yours. So that's my biggest takeaway from my past.
And as an investor, we're looking to see if those fractures might be there. So, Aaron, what have you seen when you've heard pitches and you've observed founding teams that they may not realize they were putting out there, but that as the investor, it gave you information and, you know, kind of pulled you in one direction or another on that startup?
Yeah, absolutely. So I'm saying this as the vibes guy. If I ever co-found anything, I will be the vibes guy. So I can say this about vibes guys. The things that are a through line in pitches that I've heard at both Pioneer Square Labs and at PAC VC that people have been hesitant to pursue as investments are when one founder is the one not just pitching, but also with the technical capabilities to kind of do everything. And the other founder is like, oh yeah, and they had this idea with me, so they're coming along for the ride. In venture and angel investing, it's so important to have a really, really highly efficacious first 5 to 10 employees that do very non-redundant tasks, that it's really stressful to investors when we know that most of our investment is going to a payroll that doesn't necessarily get you more customers or get your product closer to being ready to deliver to a lot of customers at scale. And I think the biggest mistake that I see a lot of people who've pitched PSL and PAC make is coming to us and feeling like they have to have a fully fleshed out about us slide and a fully fleshed out like team. It's totally fine, actually, if someone comes to us and Minda calls it intellectual honesty, which I think is good, and says, here's what I don't know, and also here's who I don't know that could do something really important for me. Like I want this money to grow my company to the next stage, and I'm gonna need help recruiting someone who's this type of engineer. Or all my friends are engineers, and I don't know anyone who's really good at marketing this particular type of product for like health providers.
And it's also okay if you come into those conversations and say, well, I have my technical counterpart, but they're still full-time at Amazon. And so what I would say is, great, when you get this funding, let's say you're raising $750K, will they be leaving their full-time job? And to me, that's an okay scenario. I just want to know that they are leaving.
Yeah, and we'll get to this, I think, when we talk about kind of pitch decks as well. By the time you pitch, you've already talked to someone at the firm quite a few times. I've never been in a pitch that's gone from slide 1 to slide 10. It's always like, hey, nice to see you again. I guess we'll start at slide 7 because you seem to have questions about that the last time we were on the phone. It's very similar with teams. If you're not 100% confident that you have the people in place to merit, getting a venture round, it's okay to talk to your investors about that and say, do you have anyone in your network that you would recommend that could come in part-time to be my CFO, or, to come in for a 6-month gig to help out, build this marketing or sales function.
Yeah.
They'd be really
I like
stoked
what
to
you're,
help with
I would say I would double click on one thing you said, which is that you really want that highly efficacious pairing. So too many co-founders dilutes ownership and doesn't work well for decision making and leadership at the beginning. You do want a tight team, but I think the core thing you really want to be able to say to an investor is, we can build it and we can sell it. And you don't have to be a salesperson to be great at being a founder seller. And I think that's another thing. A lot of people think, well, I need a salesperson. And actually, no, you are the best salesperson. So the pitch is your first sort of opportunity to prove that a little bit.
Yeah, looks like we have a question.
Awesome.
So I think I have like 2 questions. So the first question is, what I'm hearing you saying is, it's not a weakness if the founder goes in and says, this is our idea, this is our proof of concept. We have a roadmap, but we need to flesh out the technical skills in this area to build this product. So that's not a weakness. Fantastic.
I think you just have to always come in with the truth. And then they're going to say, well, where's your traction?
Yeah, that's
Right.
always the follow-up question is, where's
Right.
the traction coming from? Where's the momentum
And then
coming
you're like,
from?
well, what is traction, right? And I actually have an answer. It is, the first thing you are doing is you are proving that your value proposition is working. The trailing indicator of that is revenue, right? So think about those pieces and any proxies that you can get on those things. Value proposition is a 2-part deal. It is your product and offering and how it matches with a specific customer and the jobs that they need done, the pains and the opportunities that you bring them. So maybe you don't need to build it, you need to prototype it. And you can get traction by saying that when they tried our prototype, that, yeah, it didn't have single sign-on. It didn't have it wasn't on premises. It was in the cloud. It was all this. But they're doing this and buying this, right? So you're proving out your value proposition, and that's traction. And when it gets easier to get a new customer, like a shorter time and less money to do that, that's a signal that you have traction. Also, just what is the change you're trying to bring into the world, and what's your business model for that? And I think evidence on your business model path, you can be creative about where you find traction within that bigger strategy. You just want to know that it is like core to proving your value proposition. And I just think those 2 parts, if you really can exemplify some experience of that, that builds investor confidence, even if you don't have the full technical product yet.
Okay, that's helpful. And then one more quick follow-up is, I have heard kind of mixed preferences on single founders versus co-founders. And sometimes I hear the narrative of investors prefer co-founders. And sometimes I hear the narrative of they just want the one founder. So I'd like to get your thoughts on that.
What have you seen, Aaron?
Yeah, well, I'm curious what you 2 have seen in different kind of like angel syndicate pitches and meetings, but I guess like my quick take is that co-founders always with the footnote that it's okay if someone comes in and has a really strong grasp of the customers and like what type of person they're trying to solve a problem for, and they say, I'm raising a venture round because I want to get this to market quickly and I want to do it at scale and I need to hire a team, and I think I'm looking to hire a co-founder who can like help with my weaknesses. Some investors, like whether you're doing angels or venture, will say, oh, like that's not right for me, but I'll introduce you to other people and other funds that I know that are much better at handling like this type of
And
thing.
is getting a referral from an investor who said no a good
it's
idea?
Amazing. That's where most deal flow comes from. Like people are I would say like,
And some people would say the exact opposite. So it's like, welcome to the world of people have totally different opinions.
I would say in Seattle,
People do share a lot of deals and they say, but I'm not investing.
Yes.
And here's why.
Yeah.
As long as the why is something about like, well, I don't invest in life sciences. So that's not adverse sharing.
But like Tammy and Yule, does Keiretsu or Madrona have co-founder versus solo preferences?
I think in what I've seen in Keiretsu is it doesn't really matter in a way that if you have both co-founder, explain why. maybe one person good at one thing, the other person good at another thing, and they complement each other and they work well with each other, and that's totally fine. And I don't think anybody will say no to that. And same for one person, if you like working, leading the team by yourself, and then you have more control over that. And if it works well for you, that's fine too.
I think the main thing that I think needs to be that a co-founder de-risks is that you are able to persuade someone with a different skill set that this is a good idea and that they should work with you and that you guys could come to an agreement. And so then I get a sense for the dynamic of what team will be built around it, since those first 2 to 5 people are so critical. Question, yeah.
I had a question kind of related to the last one. So with regard to people who don't have technical co-founders, how often do you have people come in with user research for the product?
I would say I love to talk to founders before they're officially pitching with that kind of ideation level, right? And what I would say is that let's turn that user research into a value proposition and test it out. And there are a lot of ways you can test a value proposition, but research is sort of like, it can be interpreted so many different ways that I want to know how you're interpreting it into a product that can be sold to a specific person. And so with that hypothesis, I want to know before I can invest, I need to know what you've learned about the customer.
Mm-hmm. Or maybe like user interviews.
Yeah, a lot of the value proposition design work is being clever about interviews, where you ask questions that give you insights instead of happy ears. Like, I'm going to show you a demo and you're going to tell me what you think. That is probably the least helpful thing you could do, because they'll say, oh, it looks really interesting. Have either of you kind of experienced founders that are really tuned into the customer versus where you feel like there might not be a close enough kind of alignment and deep knowledge? Like, does that ever show up for you in things you've seen?
Well, I think like what comes to mind actually is CPG. So the startup that I helped build this summer was about food manufacturing and kind of incorporating sustainable ingredients and de-risking them. Like there's a lot of folks who say like, oh, I as a bartender have a total lock on people who like, you know, this type of mixed drink and it's just not available in a can. And so this is what I propose, and I'm gonna go find a food manufacturer that has like a huge beverage bottling plant to make this for me, and I need to raise money for it. Like that's pretty common. And in cosmetics, isn't that how it works also? Like you can go and
Yeah, so I think before we even started working on products, we did a lot of user research, and I think like per my experience, that's like one of the most important things a founder should do before they're making a product.
Mm-hmm. Mm-hmm.
So it would be okay if someone came to PAC, I think, and was like, hey, I'm a UW alum and I really care about solving this problem for a customer base. Mm-hmm. And to be honest, I'm just gonna hire someone to build this website for me, because like having the service and having the insider knowledge of this demographic is more important than being a coder.
Because you're attached to the problem that the customer has, not the solution building.
Yeah.
So I think it's about where your passion shows up is really what we're saying. Like if you walk in and you say, this research is compelling, I would want to know like in what way and what is the change that you want to bring about in the world, and do your eyes light up? I think I saw other hands. Yeah.
I think this co-founder topic is very compelling here. I mentor a lot of teams that come through CoMotion. They originate in research, and you get to the topic of who's going to be CEO, and you get this. Mm-hmm. So I think it's important to kind of flesh out what are the options, what are the paths to success. I mean, the investor referred co-founder direction is one. I'm sure there are others that you've seen succeed. I'd love to mm-hmm. hear about them.
Yeah, I mean, I think that having a small trial time together where you work on a very specific and distinct project that allows you both to do that without jumping in 100% on any legal connection between you two. It can be a consulting project, et cetera. But I do think that testing out that working relationship up front and knowing that that is sort of a test time for each other is really good. Also, having your significant others and you all go out to dinner together. I've always done it. I think it is very telling. You find out that that significant other is not so hot on them leaving Amazon, and that clock's ticking. About 6 months from now, I want you to be making I want you to be replacing your salary that you used to bring in from Amazon. And as the co-founder, you might not have really gotten that until you went out to dinner. Yeah.
I wanted to follow up and ask, with your co-founder divorces, what happened to the baby?
I would say the company is still growing very strong. I think currently it's one of the top 10 emerging cosmetics brand in China. So for me, I think I don't want the baby to die. What I did is actually I did like financial models to see what I want the end result be, and backwardly to see, okay, what can I make compromise and what I want. Because I to be honest, I'm not engaged in daily operation. What I care more about is actually what's my exit gonna be. So that's what I did. Yeah.
So I personally haven't had a founder divorce, but the last company I worked at before business school had a major founder divorce. And I think what's really interesting, it was biotech. I don't know if any of you are involved in life sciences here, but it was a CSO and founder and the CEO who also had a PhD in molecular bio, but had been a Goldman Sachs biotech banker. And so was coming in with like very strong financial and kind of fundraising and clinical trial management chops. And in the split up, like essentially the research division got completely gutted at the company, and those researchers actually ended up starting their own kind of contract research organization, VC thing, that's actually doing really well and is pretty awesome. But it was a major sticking point with the VCs that invested in our biotech startup because they felt that there is a lack of honesty in the CSO and the CEO when they were not talking about being on the same page for spinning down research and really focusing on clinical trials. It's so expensive to run them, and that kind of lack of communication actually spooked a lot of investors. And so I would just say the golden rule here is like, you don't have to have it all figured out. Like no investor expects you to like literally know everything about business and the future of the world, but you do have to just be like pretty upfront with your co-founders and with your investors about like, all right, cool. Like, you know,
when this becomes less about commercializing my personal research, I get less interested. And I want to go and I want to keep doing the research. I don't want to go into a managerial role.
Yeah, and it's okay to say like, I really care about this customer base, and I also am really creative, and I get so bored doing the same thing over and over again. And that's okay to talk to investors about, because they might have frank conversations with you, but at least they're having those conversations.
And I do think that it sort of applies even outside. Like, so my outcome of my co-founder divorce is that the baby died because of COVID, because no one was using their office break rooms in the same way anymore and never would. And we really relied on having office break rooms and people in them. So that kind of killed that one. But I think that there are, whether you're an employee or a co-founder, you should know if you're an explorer, an expander, or an extractor. And knowing which one of those you are, it means that you get excited about delivering a certain kind of value, and you get bored and feel antsy being asked to do those other kinds of things. So if you get someone who's really senior and who's been a really good extractor and try and make them into an explorer, they get very managerial about something that should be very explorative, and it doesn't work as well. And their value add was always in being able to optimize. And now you're asking them to do things that are not about optimizing, they're about proving the value prop, and who cares that it costs twice as much to do X, Y, Z? And they're looking, at success and value in a really different way and how they deliver it. So know that about yourself. Like, I identify as an explorer. That's why I love pre-seed. That's why I like working with pre-seed. I was talking to someone yesterday who has a business that's gotten into this deeply operational place. And I toured her warehouse last night, and I was like, oh my gosh, I could never be part of this. I could never deal with 100,000 pieces of clothing, moving and dry cleaning and operations and all that flow. And she lights up with it. So, yeah.
Cool.
Okay, so when is VC funding not a match? And I'm going to ask you a question, because you were in the end zone for a lot of things. Can you tell us about the variety of exit multiples that you saw across different kinds of businesses?
I think that's a good question, because depends on I would say my first definition of different business first come to mind is industry. Different industry, they have exit multiple, and usually what we do is basically benchmark your company, benchmarking it with the public company that in the same industry or doing the same business. That's one of the major valuation strategy we usually do. And I know in Seattle, we mostly are tech companies. And the other thing to consider when you consider valuation is also about your size of business and your I would say the monopolistic value or power you have. And that could also kind of differentiate your companies from other existing big techs. And so I would say that's
And so sometimes exit multiples in the software space are based on just top line revenue.
Exactly.
Like,
yeah.
multiply it times 10. What about a CPG company? Do you get to multiply your top revenue line times 10 and call that a valuation?
That's definitely not the case. That's also an interesting question, because for CPG companies, my company, we were bootstrapped, so we didn't actually use any VC money. The reason why is because we didn't believe in the network effects. That's back to the 3 years ago, lots of VC believed in CPG companies that, if you ever raise more VC money, you can have the monopoly power in the brand markets and you can starting to make profits. And we didn't believe in that. So we started on and we proved our business model 6 months after founding our company. So which means we start making profits after 6 months. And that's also a reason why I think that big tech's valuation is different from CPG. If I was doing, I'm still doing the investment, I would never value a CPG company 10 times revenue. Instead, I maybe look more in their bottom line, the profits or EBITDA.
Exactly.
Yeah.
So certain companies, especially in CPG, are evaluated on EBITDA. So to me, there are sort of 3 reasons companies are bought, and I'd love to see if I get this right, because you're the teacher on this one. You own or license something that is you've proven to be an extremely valuable asset, like a molecule that has a small molecule therapy that's made it into the later stages of clinical trials, right? They don't want to buy you because you know how to manufacture it. They have manufacturing. They can take that on. What they want to know is that you've gotten to this point. You have an asset of value. The other thing is that you have a value prop that works and it's generating a ton of revenue, right? And if you're in a highly scalable business like software, then everything else almost doesn't matter because it can get optimized. And then the other reason that you might be acquired is because you have, you're a cash cow. You just put off cash, like profit, right? So those are sort of the three categories of reasons that you would want to work to for an exit, and which one do you think you'll be?
Yeah, I think totally. And also, maybe like recently we've seen lots of like teams that got acquired instead of a company got acquired. I don't know,
Right.
Minda, you have more takes on
Yeah,
that.
I would say like that for an investor is probably a pretty low outcome in terms of investment return. But I like thinking from the exit back to today as a reason to say like, this actually is a great application of venture capital because it's going to actually be the necessary thing. You didn't need it, so it actually is the wrong fit, right? So a lot of times we think venture capital is the right fit when in fact we just need to be creative about maybe getting specialized payment terms from a supplier that allows us to have 90 days and we can return the cash in 30 days. There are a lot of companies that can kind of build up that way. Venture capital is the most expensive capital that you can have for your company. It is also harder to fire an investor than it is a co-founder. And you're stuck with us once you get us. Hopefully you like us. But yeah, it is really a match between your business model and the VC's box for returning the investment that they make.
I just have a note to add it for PAC VC. So it's really interesting. We get a lot of current students and alumni, which is amazing. Like that's why we exist. But I think the conversation that always surprises me that I have, like I'm a graduate student fellow at PAC. I'm not even a partner. And so my job is really to meet with people as kind of an initial conversation. And it surprises me how many founders don't realize that the kind of idea behind venture capital is that you have an exit usually within 7 or 8, at most 10 years of getting that funding.
And why is that timeline so critical?
It's the traditional structure of venture capital in the US. Like the way that venture capitalists raise money is we go and we ask people for money and we say, we're going to at least triple your money in 10 years. That's how long the fund is. And so we're raising our second fund right now. If we wrote you a $250,000 check for your startup, ideally within 9 years at this point, because we started raising last year, you would either sell the company or go public so that we could sell our shares, and our exit would be worth 10 to 100x.
Right. So you have to have the potential to be $1 billion company to fit our model. It's not that other businesses aren't good businesses. You'll probably be a lot wealthier actually as a founder because in the end, let's say you raise $500 million and you're like, you can raise venture capital all day long. You're just feeling great. Mm-hmm. And you sell your company and you're like, wow, this is great. And someone's like, yeah, how's your exit? You're like, well, we sold for $600 million. And they're like, oh my gosh, you must be loaded. Why, Tammy, why do you think that's not necessarily the case?
Let me think about this for a
Okay. I know, I'm putting you on the spot with some math here. But like, have you guys seen the TikTok waterfall challenge? Okay, so we're in a row and he's holding the cup and Tammy's holding a cup.
I pour it over.
Yuli's holding a cup.
Yeah.
And you pour it. Okay, so you start. Who are you? Who's first in line for the liquidity coming in from an exit?
This would just be the first investors.
Or the bank.
Or the bank.
Silicon Valley Bank gets to sit first.
Yeah.
They put any money in for venture debt or any debt. Anybody who you owe, they're first. So Aaron, you're the debt.
Yeah, so I would pour it very inefficiently into the next cup, and it would just get incredibly diluted.
Yep, and I think in you, let's call you the Series D investor. You came in last year, and here you are at the front of the line. Like, I don't know about that. What's your liquidation preference?
My liquidation preference definitely adds more front in the line, the better. And if I came in later, I have more seniority in the equity too. So I'm gonna squeeze.
So you're a 2x of your investment at minimum, right? So do you have any more water to pour for Tammy, who is our pre-seed investor?
Yeah, hopefully if we're friends, so I can.
For me, hopefully I for sure want that, but probably not.
Yeah, it might be pretty empty. And I'm the founder. I'm last. So my pre-seed investors may make nothing. I may make nothing, even though we exited for $600 million, but we raised 500. So the banks get paid, and your senior investors get paid, and everybody else is like, as a founder, there's something called a carve out that I might get to do. I might get a certain amount where it's like, look, we know it's going to be nothing, but here is a carve out for you as the founder, and really great founders make that accessible to the employees. But that's a lot of times at their discretion.
Yeah, we're not trying to scare you off of venture capital, but it is good to be
If we've unsold it a little bit, then I think we've done the right thing, actually.
And hopefully, at least a big takeaway, I would love to talk to any of you if you're interested in funding from PAC. But what I'll say is, like, it is okay to admit that you have a lot of care for your customers and you really want to solve a problem and you're not 100% confident venture is the right type of financing. I don't know a single VC in Seattle, at least, that is like trying to shark you out of money and be like, oh yeah, you should definitely get VC funding and I'm gonna like torture your very existence to extract the most value out of this. That's not how people are.
No.
Because everyone knows everyone in this scene, and their reputational hit would be too much to do that to you.
Question.
Yeah, on the topic, can you expand a little bit about how interactions between a founder and an initial investor compare with a later stage investor, and how does that evolve over time? Is there some sort of drop off in interactions? I know you said you like to explore, right? And you don't like it when it gets too heavy on the operations. So how does that transition work?
So Tammy, you've been around Keiretsu a little bit, and they invest at a slightly later stage. And so what is that relationship like with the founder that they've invested in, or about what expectations do you think they set?
They would, in terms of
Because they kind of come along like seed or Series A. Are they expecting a board seat? Do you think?
Not really. I don't think so. No.
Yeah, not always. So do you think that do they do follow-on funding?
Sometimes, but I don't think that's a very typical case for Keiretsu.
So those are two main relationships you might have that are pretty structural. Do they follow on invest? And do they want a voting board seat? And those are really important questions to know in advance. Everything else is just them trying to be helpful, which, how does that work?
So it's very rare that one VC or one angel investor will be your entire funding round. It's like a group of them will get together, and in lingo, it's called the syndicate.
Yes.
And so, like, let's say that, like, PAC, like, we got together to try and
First row and PAC, co-invest.
Yeah, like, we could co-invest. Probably there might be like 2 or 3, if not more, other like venture funds or angel funds investing with us. One of the 5 of us would lead kind of negotiations with you on behalf of the other venture firms. So a reason why venture capitalists, especially in a town like Seattle with a limited number of them, are generally nice to each other and pass around a lot of deals is because they're almost always co-invested.
Or hoping to.
Yeah, with someone else.
Right. Or they want, like, as first row, I would really like for Madrona to invest in my companies. So those relationships sort of between investors matter. I would say, though, about lead investors is that is a very specific kind of expectation you should have. They should help you close the round. They should be the one that sort of wrangles the rest of the round and keeps everybody on the same page with you as you move forward and they should really walk you into the next set of investors. They should be saying to you, like, hey, you guys are moving fast. This is awesome. Let's go out early, right? So they're the market for capital expert on your side for the next stage. As pre-seed, I don't pretend to be that. So it's also really, and then everything else is they try and like make customer intros and do all these things that can feel like a distraction, honestly. So I think mostly we tell founders that, we are most helpful, least annoying.
And just whatever you do, if you are working with early stage investors and someone says, hey, like, I'd really like to, like, I'm used to leading the round. Like I'm good at syndicate wrangling. It's very not cool to start talking to other people in the syndicate without looping in that person. Like once you get kind of someone who's willing to do the herding cats of being the negotiator, like really they should be your point person in my experience.
Yeah, you want to partner with them to close the round and not try and, it can get a little dicey. You're talking about new relationships and everybody coming together. So yeah, it can get a little squirrely sometimes, but you as the founder, work with your lead. Yeah. Does Carezzo lead rounds, Tammy?
I think so.
Yeah, I think they do. I think they like to lead.
Yeah. One thing I noticed in terms of like introducing customers, I was talking to a potential investor for a company after the pitch deck. He mentioned that the investor mentioned that he can provide a lot of customer introductions to the founder, and they've been talking for a couple of rounds or for a couple of weeks. And then when I follow up on a couple months later or a month or two later, the investor mentioned that, oh, that investor keep calling me every day. It's so annoying that just don't want to pick up the call anymore. So, sometimes that type of relationship may not, you don't want to put all the hope in one person to kind of bring in all the investments or the customers.
Yeah, I think it's usually kind of a stretch. If that's a promise, I would go diligence the investor, actually. I would do that regardless. Yeah. Other questions? I want to talk really quickly then about diligencing your investors, because you really, really should. How would you diligence investors? I'll ask you guys, and I'll fill in any extras.
I think really be clear about what your objective of your companies and your teams are. Like, are you actually looking only for funds, or are you actually also looking for resources? And that's a key thing that you want to distinguish between different investors.
Yeah. Anything else from you guys? How would you diligence investors? Because they're diligencing, the founder.
I have a side note about Pioneer Square Labs, if that's okay. That involves diligencing investors. So there's studios like Madrona Venture Labs, Pioneer Square Labs, RIP Techstars. Someday it might come back, or something will rise from its ashes. And studios are a really unique type of investor. It's not just like free resources and like kombucha and coffee machines.
You have kombucha there?
Yeah, typically kombucha is like a very standard item in a startup studio. Sorry. But so anyway, they they're an investor and you need to diligence them. And I would say that like working at Pioneer Square Labs, one of my favorite parts about it is that they try really, really hard to remove equity from people who work on projects early, because they want those people to feel unemotional about just killing something that isn't getting customer traction. And some people who are really creative and like coming up with ideas are very precious about their ideas. And they take it very personally if their idea gets killed because it's not getting customer traction. And so like that, there's an absolute place for entrepreneurs who doggedly pursue the perfection of a product, even if the customers aren't entirely clear at first. But those are not the type of people that should go to certain types of investors, including studios.
Yeah.
And so like that's the
So you got to be a match for the kind of investor that it is.
Yeah, and it's like a spiritual question that you need to ask yourself.
A lot of spiritual questions you should be asking yourselves if you're in this room.
Yeah,
honestly.
but that's
like, my daughter says, she's 20, and she's like, you need to be a little bit self-deluded, right? And I was like, yeah. She's like, no, I mean you, the investor. I was like, oh, yeah, me. I guess we all have to be a little bit self-deluded. But go on LinkedIn and find portfolio companies that they have and talk to those founders and find out if they are happy with having had that investor come in. Did they follow through on their promises? It's very fair for you to do that. You can ask a VC for references, and you can also just do them, on your own. I know people who have diligenced Pioneer Square Studios before they go in and talked to other people who've gone through it.
Yeah.
So highly recommend that.
The other thing you can do is you can get a student intern from University of Washington, and their library access gets you crazy info from, like, you get all of these subscription seats to like PitchBook and like crazy investor research tools. And so if you hire a UW grad student for 5 hours a week to help you do investor diligence, it's worth the money because it's so much cheaper than getting a PitchBook seat.
That is a really good hot
And
tip.
that is my hot tip.
That's
It's
a hot
very
tip.
easy to get an MBA.
So let's talk a little bit about like back to UW. So our angel investing class, we're always interested in deals, and they are the ones you should go talk to, not me. My job is to make sure that they're asking themselves the right questions and doing the right research and diligence. And then they present to a small investment committee and they say, we're ready to make this investment. You just need to like approve that we haven't really screwed up. Right? So it's like they're not asking sort of like, is this a good idea? They're saying, this is a good idea, and here's why we want to do it. And then they make the case. So I'm the facilitator. They're the investors. We write 2 25K checks every year. Theoretically, we could write 1 50K check, but we try not to do that because the purpose of the investment is the educational experience of sourcing it, screening it, diligencing it, and getting it across the line. And the cap table is the University of Washington. So it doesn't say students from the University of Washington's angel investing class. It says University of Washington. And that is valuable in and of itself, often as a credibility builder.
Curious, who's actually paying the money?
So the Burke Center for Entrepreneurship has the funds that support this class, and they're always looking for people who want to donate into that fund, and then the funds come back and support students making new investments. So it's very much a sort of evergreen idea, and the class has been around for about 12 years, and so far they have investments that are still going, but they've returned 100% of the cash they've put out. So I think you guys do pretty well.
How are we doing on time? Should we just do open Q&A? 4 minutes? Yeah.
Can you speak to the difference between if you're a startup founder and getting money from an angel investor versus a venture capital firm?
Mm-hmm. I'm going to let Tammy take this one. Because you're sort of Karitsu's a little bit of both.
Yeah, a little
But
bit of both.
what's the key difference?
So I guess the key difference I see on the VC is they're more later stage. The fund is usually larger, whereas angel investing is more earlier stage, smaller fund, and they usually exit earlier because afterwards they really don't get much after the water pouring. I guess.
Mm-hmm. So angel investors are individuals investing their own money. So they may decide to buy a boat instead of investing in your company.
Yeah.
Or your fund.
Yeah.
So
I'm talking about the difference between, say, an angel fund
okay.
and, for example, a pre-seed investor like First Row Partners.
Okay. So an angel fund like Karetsu. They raise from individual angels, and sometimes, depending on the structure, the angels might be the decision-making body. It might be consensus and voting. Sometimes it is just based on the manager of that fund co-investing as the individual angels make investments. That would be Alliance of Angels style, where you go in and you pitch the room, and certain investors get really excited. They form a diligence team, and they individually make investment decisions. And then also the annual fund that has contributions from many of the investors may also make a decision to invest alongside. So that can happen. I would say that each angel investor group has its own structure. Pre-seed investing, usually it's a pretty tight decision-making process. And rarely are you going to find like a huge amount of multi-stage. I would say Tammy's right about like, we know that the waterfall thing can be really a dry desert if we hold on too long. And I think angels are often bought off the cap table at a certain point. And a lot of angels expect that, and they can make great returns because they don't have the overhead of a fund, whereas a fund may need to continue to be on that cap table. Does that answer a little bit about?
And from the perspective, so that spoke a lot about mechanics,
Mm-hmm.
differences. What about from the founder's
I can
Go
answer.
for it.
So the really passionate angels I know really care about a certain type of technology. Seattle has a lot of software investors who are Microsoft early employees, and they really care about a specific corner of tech, and they can introduce you to other people that share that like passion and the ability to connect you to folks to like help out with like the technical build out or fundraising in a more like deep
So
tech.
angels do like to get more involved as individuals often, and that can be good and bad.
It's a passion project for an angel. So you're pitching an angel on passion for either the customers that you're helping out or your technology, whereas a fund, you're pitching them on the size of the return and whether or not your technology fits their technical expertise and ability to do diligence on you. So for you, it would be if you were doing B2B SaaS, building off of AI, and you're looking for a fund, you're looking for a fund that knows how those companies operate so that they can help you get technical employees and other investors. And if you're looking for an angel, then you're just looking for an angel who really cares about what you're doing and is undaunted by the fact that they made their money in an era before AI was even a thing.
Right. They call it angel investing because it really is like a gift from heaven. It's faith capital. They call it friends, family, and fools is your first round. So they would be the fools in that equation. I guess, pre-seed investors may be the same. We just try and be professional about it because we're having, we have a fiduciary responsibility to our limited partners who are the people who give us the funds. And so that is first and foremost who we work for. Whereas angels and angel funds are really on behalf of the group or the individual. And if it's an individual angel, they have a different return profile that can make them able to invest in opportunities that are below the threshold of what a VC needs to see. And so you don't maybe have to have $1 billion potential, but it looks like in 5 years, they could get like a 6X. For an angel, yay. For a VC, that's like that's a write-off, sometimes. They're looking for at least 10 and or more. So, they look at different things, I think.
All right. Well, thank you everybody for coming in, and please, this was a wonderful panel for our opening session this spring winter. So give a nice round of applause.
Thank you.